Canadian winters in Arizona about 120 days a year. He never hits 183. The IRS can still count him as a U.S. taxpayer. So, let's start from zero. A snowbird is a Canadian who spends the winter down south, Arizona, Florida, Texas, to get out of the cold. Do that year after year, and the United States runs a quiet day-counting test that can decide you're a U.S. taxpayer, even if you never felt like one. Cross the line, and the IRS can start treating your Canadian pension, your RRIF, your whole worldwide income as reportable to the United States. And almost everyone aims at the wrong number, 183, when the real line sits far lower. Stick with me, and you'll walk away with three things: the real cutoff, the one form that protects you, and the June deadline you can't miss. Two quick honesty notes before we go further. If you hold a U.S. passport or a green card, this form is not your fix. That is a different, more serious conversation, and you want a cross-border specialist for it. And if you cross 183 days in a single year, this form is off the table for you too. Now, hold two people in your head, Margaret and David. Same Arizona condo, same roughly 120 days every winter, same Canadian home. One filed a single form on time. One filed nothing. Same days, opposite outcomes. We'll come back to them. We walk through this in 5 moves. The day counting test sets the table. The 3-year math is the part everyone gets wrong. Then the separate report nobody warns you about. The treaty rulebook is the move people think saves them and only half does. And the one form you file by June is the fix, plus the trap to watch for after. Start with the test itself. The IRS calls it the Substantial Presence Test, which is just the IRS's day counting test for who counts as a U.S. taxpayer. It does not care how you feel about your citizenship. It cares how many days your feet were on U.S. soil. A few things matter for the count. There's a floor first. You have to be in the United States at least 31 days in the current year before the test even applies to you. Below that, you can stop worrying. Above it, the counting begins. And the United States means something specific here. The 50 states plus Washington, D.C. Not the territories, not the airspace on your flight to Cancun, just the ground you actually stand on in the country. One more piece people miss. Partial days count. The day you land and the day you fly home each count as a full day on U.S. soil, even if you were only there a few hours. There are a couple of narrow exceptions, like a quick transit of under a day, but for a snowbird sitting in a condo all winter, every day in is a day counted. So that's the test. The part that catches people is that you can pass it without ever spending a single full winter over the line. Here's the math that does it. That brings us to the second move, and it's the one everyone gets wrong. People hear 183 days and assume one winter, counted once. The IRS does not count it that way. It counts 3 years at the same time. Here is how it actually works, and the whiteboard carries the full math while I keep it plain. The test takes all of this year's U.S. days. Then it adds a slice of last year's and a smaller slice of the year before that. Stack those 3 together, and you get your number for the test. Run a steady snowbird through it. Around 120 days a year, every year, the same Arizona winter on repeat. No single year is anywhere near 183. But once the IRS adds the slice of last year and the slice of the year before, it adds up to 183. The test is met. Think about that for a second. You never spent 183 days in one winter. You never felt like you crossed any line. And on paper, the IRS counts you as a U.S. tax resident anyway, unless you claim an exception. That's the hidden line we opened with. It isn't 183 in a single year. For a steady snowbird, it's closer to 120 every year, and most people never see it coming. That's the residency side. But there's a second piece of paper most snowbirds have never heard of, and it has nothing to do with the IRS. If this just saved you from miscounting your U.S. days and walking into a reclassification, Hit that like button so the algorithm warns other Canadian snowbirds before next winter. The third move surprises almost everyone. It's a report called the FBAR, a separate report listing foreign accounts that top $10,000 combined. Combined is the key word, not one account over 10,000, all of them added together. Now here's the part that turns people's heads. If the day count makes you a U.S. tax person, your Canadian accounts become the foreign accounts you have to report. Your checking in Calgary, your savings, your investments. Once they cross $10,000 together, they go on the report. And this one does not go to the IRS at all. It goes to a different agency, FinCEN, the financial crimes arm of the U.S. Treasury. Different agency, different system, but the deadline still rides the spring tax season timeline, with an automatic extension to the fall. You file it online, not on any tax return. Now for the part that matters most. This report only lands on you if the day count makes you a U.S. tax person. The snowbird who walks into it is the one who passes the test and protects nothing. File Form 8840 and you're treated as a non-resident, so the FBAR question falls away with the residency. The danger was never the form. It's doing nothing. Now, you might be thinking the Canada-US tax treaty has your back. It does, partly. Where it stops is what surprises people. The fourth move is the treaty, and it's where most people think the whole problem disappears. The treaty is a rule book between Canada and the U.S. that decides which country gets to call you a resident. When both countries could claim you, the treaty breaks the tie. It walks down a ladder where your permanent home is, where your life is centered, where you habitually live, and so on, until one country wins. For a genuine snowbird who keeps a home in Canada, a family, a doctor, a bank, the tie usually breaks in Canada's favor. That sounds like the end of the story. It isn't. And this is where the treaty stops. It decides which country taxes you as a resident. It does not automatically settle every U.S. obligation, and it does not rescue a U.S. citizen or green card holder. So the heavier paths, crossing 183 in 1 year or holding U.S. status, belong with a cross-border specialist. The treaty answers one question, not all of them. That's the carve-out from the start. Back again. There's a clause that lets the U.S. keep taxing its own citizens and green card holders, no matter what the tiebreaker says. For dual nationals, that's genuinely a heavier path. One honest boundary, so nobody panics. This is all about wintering away while your real life stays in Canada. If you actually pull up stakes and immigrate, that's a separate departure tax conversation, not the snowbird in this video. Before the fix, one honest word about your Canadian side, where most of your retirement money actually lives. There's one thing this whole video keeps circling back to. Through all of it, you stay a Canadian tax resident. Your real life is here, so your investing home should be here too. That's the part you actually control, and it's worth getting right while you sort out the U.S. side. So the practical step on the Canadian side. Keep your registered and non-registered accounts in one place you'll actually log into from the condo. Check them. Keep the paperwork clean. At a lot of banks, that means a branch visit and forms by mail, which is the last thing you want to deal with from Arizona. That's why I use WealthSimple for the Canadian side accounts. You open and manage it from your phone on the couch. Log in, pick the account, move the money. Done in minutes, even while you're south for the winter. A quick word on the referral. Fund $100 and you get $25. To be straight with you, I get $25 too. The link and whatever the offer says today are in the description, since WealthSimple can change it. Now the honest part. This does not touch your U.S. filing. Not the day count, not Form 8840, not the FBAR. For that, you need a cross-border specialist, and it's far from your only choice. Your own bank or any solid Canadian brokerage will hold the very same accounts, with your residency unaffected whoever you pick. Pick whichever you'll actually use. What WealthSimple covers is the Canadian side investing home, nothing more. And the final move is the fix, the form that separates our two snowbirds. This is where Margaret and David part ways. Same days, opposite outcomes. David did one thing. He filed Form 8840, the form where you tell the IRS your real life and your tax home are in Canada. The IRS accepts he's closer connected to Canada, and he is not treated as a U.S. tax resident for the year. Margaret assumed under 183 meant safe, filed nothing, and left herself exposed to being reclassified, with her worldwide income on the U.S. table and a much harder fight ahead. 2 things to know about that form. It's filed per person per year. If you and your spouse both winter south, that's 1 each every single year. And it's something you state yourself, not something the IRS approves. There's no acceptance letter. You assert it on time and keep your records. And the timing is live right now. June 15th is the date if you have no U.S. income to report. But if you earn U.S. income that makes you file a U.S. return, the form rides with that return, and the date can be earlier, in April. A specialist will tell you which one is you, and check your actual days and ties at the same time. That's the move that protects you. The deadline is closer than you think, and there's one more Canadian retirement trap costing people $3,000 a year that you'll want to see next. So here's the whole thing in one breath. The line isn't 183 days in one winter. For a steady snowbird, it can be closer to 120 days a year, because the IRS counts 3 years at once. The residency form, Form 8840, protects your residency. And protecting your residency is what keeps the FBAR off your Canadian accounts. A U.S. passport or green card is a different story. None of this means stop going south. It means count your days, know your ties, and get the paperwork right before next winter, with someone who does cross-border work for a living. If this cleared up something you'd been guessing at, subscribe so the next one reaches you before the deadline does, not after. There's one more trap waiting on the Canadian side. The RRSP mistake, quietly costing Canadians around $3,000 a year. Same idea, a rule hiding in plain sight. That one's next, and it's worth your 15 minutes. I am not your tax preparer. Verify every line with one before you sign the return. Thanks for watching.